It's Monday morning coffee talk. It's July 24th, 2023, and I want to welcome everyone to the SoFlo Real Estate Show with Athena. Our traditional lending programs preventing you as an investor from expanding your portfolio. Are you losing out on key properties? More importantly, are you losing out in building wealth? These are big concerns in today's market. My name is Athena Chalikas Barocas. I am the host and creator of the SoFlo Real Estate Show. I am also a top producer and award-winning realtor with Coldwell Banker here in sunny South Florida. So before we get started, if you happen to know somebody who's struggling with buying investment properties, this could be a very good video to share with them. So let's get to it. Let's welcome our guests. We have Danny Beydoun of FCM Home Loans. Danny, welcome to the show. I'm really happy to have you here.
Why, thank you. It's great to be here on this beautiful, sunny, and hot Monday morning.
It's zesty out here. Not only is the market sizzling in South Florida, but we're like 106 degrees. So wow. I definitely agree with you. It's crazy.
Yes. Even in Michigan today, it's 90 degrees. So that's something to be talked about.
It's hot everywhere. I think Rome was 106 today. So I don't know if I would want to be on those Spanish steps touring around.
No, thank you.
No, thank you. But before we get started, let's answer the question that's always being asked, at least to me, and I know to you, what's the rate? So let's talk about simply the 30-year rate, because that's always the most important or the most popular, yes, I should say. And if you see anything happening this week that we should know about.
Well, it's no surprise that interest rates this month, for the month of July, have been flirting with that 7% mark, 6 to 7. It's a volatile time, but that's kind of been like the de facto for the past few weeks. And as you know, much inventory in the country is still really low. In most of the country, demand is still very high in most of the country, and home values are still soaring in a lot of the country as feds are working hard to try to curb inflation.
Yeah, I agree. We've been seeing this, this attack or this correction on inflation for about 13, 14 months, and the interest rates have been floating between 6 and 7%. So it's not so unusual to see a spike during our summertime here in South Florida.
Agreed.
Let's get to it. I want to talk about investors and start off by talking about their importance to the housing market. CoreLogic shared in 2022, and I thought this was a very interesting statistic, that in 2022, investors were 22% of the market for American homes sold. Danny, what are you seeing in 2023, and what are some of the challenges investors are facing today?
Well, to go back to the first part of the statistics with CoreLogic being 22% of the market, even huge institutions like BlackRock have massive assets, real estate assets on their balance sheets. And it goes back to the narrative, whether it's the stock market, real estate market, when the retail person, the retail mindset runs from the market, smart money runs into the market. So what I'm seeing, even with all the gyrations, fluctuations, everything going on, it's actually creating an incentive for investors to jump on in even more knee deep, because less people are competing for the same low inventory supply that we have today. So it's actually been pretty dang good, if you ask me.
I agree with you. I think you shared an example of a nice young gal who began her investment.
Yes.
Her journey into investment. Can you share a little bit about what took place?
Yeah, she's a great story, because I wish I was thinking like her at 23 years old. She literally quit. A little background about her: she quit her daytime job at 21 years old. After she realized, after purchasing a couple multifamilies, and she's creating rental income. Wow, this exceeds my current income. And obviously, being a younger girl, she's able to do that rather quickly with, low overhead in her life at that point of her life. So fast forward, she's she's very liquid, 6 figures in her bank account. And I only know because I'm working on her loans. She's got 3 multifamilies, a triplex, 1 unit that she lives in. Very smart girl. She bought it on an FHA, moved into one, 3.5% down, moved into one of the units, rented the other 2, and that's called a mortgage hack. she was able to go into that investment. That's another topic we can talk about in another day, how we could go into opportunities like that as well. And she owns a couple other multifamilies. So, and by doing so, she's created this nice little rent roll, a very nice cushion for herself. Now she calls me up and says, "Hey, Danny, I found another multifamily in her area that she's comfortable with." They always say, attack the market that you know best, that you're most comfortable with. That's usually your backyard first before you start expanding your enterprise, for the lack of a better term. So traditional financing wasn't going to work for her because she has too many units or too many multifamilies in her name based upon her current disposition, which is her tax returns, looking at her, her profit and loss, her cash flow and her own earnings. So she said, "Danny, what can I do? I don't want to lose this opportunity." I said, "No problem. I got you covered." We could go non-traditional financing, what I call in my world, non-QM, non-quality mortgage. And all that does is it's not regulated by Fannie Mae or Freddie Mac. So it allows these correspondent lenders to get super creative. So they're taking on the risk, but for taking on the risk, they're going to charge you based on your personal unique disposition, anywhere from 1 to 2.5% above the 30-year conforming rate. So people will then sometimes will say, "Yeah, well, that's so high." Yes, that is a higher rate, but what's it worth to you? That's the $1,000,000 question. So what we do is we go through an exercise and we're like, okay, here's your current debt service, which is called your carrying cost. And then we look at it as, what is your potential income? So that we look at a couple factors. We look at cash and cash returns, COC, and we look at NOI, net operating income. It's just a very simple spreadsheet. We break things down. We look at the expenses, the vacancy rates, property management, maintenance, all the carrying costs, principal, interest, taxes, and insurance, any association dues if applicable. And then if there's a a positive cash flow, you're good to go.
No, that sounds good. And I think one of the takeaways here was really the rents, right? And how you were
Yes,
able to lose that rent roll in order to help her qualify for that additional property that would allow her to build her portfolio.
correct.
So rents are really interesting. I read a column the other day. It was an article called "Good Time for Investors to Unload." But this is really speaking about something much larger than simply selling properties. The chief economist for the National Association of Realtors gave some interesting statistics. He said in the past 3 years, rental values have increased 16.4% and property values have increased 35.5. He took it then to 5 years. And the 5 year, the rental values have increased 24.9% and the property values 50.8%. So Danny, when I invited you on the show to talk about your unique program that really drives through the cash flow in order for investors to be able to add to their portfolio and to build more wealth, I think this statistic is very interesting. What are your thoughts on it?
Yeah, it's a great statistic and it's pretty spot on. At the end of the day, real estate builds generational wealth. Wealth doesn't stop working when people go to sleep and when the market corrects. Smart money finds different ways to do different things. It gets very creative. Everybody has their own sweet spot, their own, yeah, I call it their own threshold to pain, which is risk. And depending on your risk factor is how you execute on whatever decision that you want to make. Again, smart money is out there doing smart things. So you got to be able to capitalize on it.
Exactly. And now we're looking at cash flow versus equity. And this is what I want our audience to really understand is we're talking about cash flow today and your rent rolls and how you can leverage those rent rolls to buy more properties. So
Correct.
Danny, this is so important and it's such a good topic to keep drilling down on. Let's talk about, the loans for investors and just very quickly, why traditional lenders are squeamish to lend to investors now that we know what kind of money they really have in their investments.
Yes. And it goes back, number one, remember, the banking business is just that. It's a business. And banks are publicly shared companies. They have shareholders to report to, board of directors to report to. So they like to be cautiously optimistic. So when there's a downturn, some people are calling this a soft recession versus, a hard. And let's background. You go to 2008 when everything kind of was collapsing, imploding, if you will, based upon X, Y, and Z factors. That's another podcast in itself. Um, back then, homes were highly leveraged. There was no equity, stated income, stated assets. Everybody was getting loans that they shouldn't have gotten a loan. We were doing refinance cash outs at 100%. That means that you're stripping every last bit of the equity out of the homes. That's not happening today. If you want to do a refinance cash out, no matter what, there's got to be a 20% buffer in there, keeping the home with some equity or some liquid, some pseudo liquidity in there. Back in 2008, banks were kind of oblivious to the fact. All of a sudden, there's all these non-performing notes called a mortgage sitting in their balance sheets. They started just throwing them out to the market all at one time, and it flooded the market with these underperforming notes that just significantly devalued home prices on a market by market area, which basically created an implosion. So that's not happening anymore. That's gone.
And then that is gone. Yeah. And when we have so much equity in these properties, people say, oh, it's another 2008 bubble. It is not a 2008 bubble for many reasons. And yes, it's a different podcast, but the important thing is to understand, no, we're not in 2008. Every property has equity. Every property is in a good position. Yes. And investors are in a unique position to be able to expand. So I was intrigued about the investor cash loan program. And just quickly, can you tell us how it blossomed into this great viable product, especially for today?
Yeah, and it goes back, and I think you were kind of mentioning that earlier. Today, investors, particularly most investors are self-employed, not all, but everybody's highly leveraged, and especially self-employed people are very highly leveraged because they're always investing into different things. So traditional financing for a highly leveraged smart money person just can't go the traditional route because there's something called DTI, debt to income factors. Then you look at something in a tax return called a Schedule E, which is the rental income and all that. And I'm not a tax accountant by no means, but then, they all like to get, creative, with how they're, reporting their rental income on their Schedule E's and their tax returns. So that puts them in a quagmire. They're not able to move forward and invest more smart money into the market. So we have to go to alternative financing where we don't look at income. We don't look at tax returns. We don't look at debt to income. We strictly look on the rental income offsetted by the debt service or the carrying cost of that home. If it's equal or better to, you get approved with a 630 or more credit score. But obviously, the higher the credit score, the less risk exposure to that non-QM lender, the better the rate.
That makes perfect sense. And that's what really makes this program exciting. And as we look into how the qualifications for this program differ from the traditional loans, it becomes even more exciting or more opportunistic for our investors to be able to participate in it.
I agree.
Can you share those top level differentiations as far as how these two loans differ? For example, yeah, go on, please.
No, you go ahead. Just to make sure that we're on the same page.
Yeah, of course. So, one of the things you mentioned was no debt to income ratio.
Yes.
So that's really exciting there. Tell me a little bit more about what's not included. For example, I think you said no tax returns, maybe?
Yes, there's no qualification. So traditional financing, what we call full documentation, especially after the 2008 situation that we had, all tax documents, tax transcripts are requested by the IRS, something called a 4506T form that all lenders submit in order to verify their tax returns or their W-2s to what the IRS sees. So there's no way of getting around that like people used to do back in pre-2008. So that goes away. There's absolutely no income in any capacity, no tax returns, no schedules, no W-2s, nothing that's being submitted. And there's a restriction on debt to income, right? There's a numerator and a denominator where it's all liabilities, and then there's all liabilities and housing expenses. You take a divisible of that, and there's a quotient, and the quotient can exceed a certain number, certain percentage. Again, not to get into those details right now. Well, with DSCR, debt service coverage ratio, none of that comes into existence. It's literally credit score, and it's debt, it's rental income versus the debt service of the carrying costs of that. And if it meets or exceeds with the proper credit score and the down payment, you get approved. Unlimited amount of properties in or out of an LLC. Again, that's a really big deal too. In traditional financing, you cannot finance a home inside of an LLC. You have to do it in your personal name. And then if you're going to go that route, and then on, let's say on the closing table, you go ahead and quick claim deed it into your LLC.
Mm-hmm. Okay, so that's a big one because many investors like to carry properties in an LLC for many different reasons. But what I'm hearing from you, and I want our audience to hear, you can use this program and still maintain your LLC without having to go through all those extra steps at the closing table.
That is correct. And a great rule of thumb for smart money investors is every rental property that you purchase, it should always go under its own separate LLC to limit your risk to exposure or any lawsuits or anything of that nature.
That's perfectly true. And again, another great podcast that we're going to do together.
Yes, there's a lot we could spin off from this.
There is a lot. But again, I love this program for our investors. I'm an investor. I think it's important. We've had, properties in our family. Many of my friends have properties. I'm sure you have properties. And 22% of America has properties. So this is a great program, especially over the last 5 years. If we go back to what the chief economist had shared about the equity as well as the rental values. Danny, let's talk about the types of properties. What kind of properties actually qualify for this program?
Yeah, so things have changed a lot because as things are stabilizing, the bank's balance sheets are cash flow heavy. A lot of big banks are very cash flow. I used to work at JP Morgan Chase, and which is probably one of the most, and Wall Street likes to tout them as being the fortress balance sheet. But that being said, you could actually go from 1 to 4 units. And then I have another program within the DSCR that can go 5 to 8 units. So literally under the residential umbrella, I can now go, I'll call pseudo residential 5 to 8 because traditional residential is 1 to 4. I can now go up to 8 units in 2 different types of programs.
Oh, that's wonderful. That is wonderful. So this is the kind of properties that would qualify. So single family homes are a given.
Yes, single family home, a duplex, which is 2 units, a triplex, which is 3 units, a fourplex, which is 4 units. And I don't know what you call it, a quintuplex or whatever. You could do up to 8. So like, let's say a mini apartment, with 8 units, up to 8, we can do that.
What about condos? What about non-warrantable condos? That's a big one right now.
It is, especially in Florida. So yeah, we can do condo hotels. We could do non-warrantable, and just, again, that's another podcast within itself, but non-warrantable just simply means, it can mean a few different things. When a building has more renters than primary homeowners, it's regarded as non-warrantable. If the homeowners association's balance sheets has not enough liquidity or reserves, it becomes non-warrantable, and it could go on and on. But that's what non-warrantable, and a lot of lenders, almost every single traditional lender, will not touch a non-warrantable condo.
No, they will not, and that gives a lot of investors some pause at that point.
Correct.
So this is a great solution to that. How does a lender determine risk with this program?
Again, it's very, they don't look at whether or not you're preceding, you look at your resume, how many other investment properties do you have? Obviously, they're going to look at those things, and that probably may affect your interest rate a little bit more favorably if you have the background and experience, hence, the portfolio, but that's not required. They're literally, it almost sounds too good to be true. Literally, 630 or more credit score, no income at all. We look at the rental part. Now, we do the comparable. I help them with the comparable. But there's something in the appraiser world called the 1007 form. And then when the appraiser goes out there, that's a unique type of appraisal. When they go out there, they're not only comping the value, but they're comping the rental value in the comparable area. And that's it. So the appraiser becomes, the gospel of the end all to the conversation. If that appraiser says, no, sorry, the debt service is higher, equal to or less, or I should say not equal to, less than the rental income, then it's not going to get approved.
Okay. All right. Super simple again, and a great
really
opportunity for our investors. I have a question. We're talking about properties. What if I had a single family and now I want to invest with a 4-unit? Is that possible? Can I switch the type of properties?
So are you saying like the single families are current investment property or their
Yep.
primary ownership?
No, investment to investment.
Yeah.
Am I able to do? Yeah.
Yes, it's perfectly fine. It's not an issue whatsoever.
Oh, that's awesome. Awesome. So again, more flexibility than a lot of
Yes.
different programs.
Yes.
So what is the benefit? Let's talk about this one. If I were to use the cash flow program to buy a 4-unit building, what would it entail? What would I be able to look at if I want to expand that and look at some other type of property afterwards? So, I'm looking at giving examples of how to build wealth by using your program. Can you have a specific story that you would like to share? Maybe somebody bought something 3 years ago and now has done this, and that this is their next plan. A legacy of sorts.
Yeah, I do have some clients I've been working with for a while now, and it's the same song and dance. Really, it's pretty simple. They find properties, they like it, 1, 2, 3, 4 units, up to 8 units. Like I said, they purchase it. They rent roll, positive positive cash flow. Again, I'm not an accountant, but another a great incentive of why to own investment properties over and above the equity and building generational wealth. But the cash flow in essence becomes tax free. Again, consult an accountant about that, not me. Yeah. But those are the great things behind it. So all of a sudden you have all these multiple streams of income that are coming in, and as it's building equity and value, now what my investors are doing are coming back to me and say, hey, Danny, I got all this equity now because homes are skyrocketing in value, and inventory is so low. And again, let me preface by saying today's value increase is very different than pre-2008, where that was inflated. There's nothing inflated right now. Here it's literally an economics 101, supply and demand, period. We have very high demand and very low supply, which is going to keep driving prices up, bottom line. So now all their homes are going up in the last 4 or 5 years, 10, 20, 30, 40% relative to where they're at in the market. Again, since I'm licensed in 35 states, my clients are all over the country. And now they're pulling out, or they're doing rehabs, and they're fixing it up, and it went up tremendously. Now they're pulling out that money minus the 20% equity that has to be in the house as a buffer. They're pulling in all that equity, and they're basically using OPM. Oh, it's technically their money, but the bank is giving them their money back, and they're investing into more properties and creating more cash flow and building more generational wealth.
And generational wealth is the key to success. Yes. I mean, I've talked to my investors as well, and the best benefit they always tell me is that they're going to be able to take care of their children, their children's children. And if their children's children keep this going, it goes on for a long time, and they're building a legacy. And there's no better gift than a legacy.
It is a beautiful gift of love.
It's a gift of love. So is there a loan amount limit that we need to be cognizant of in this process?
Yes, that's a very good question. And I would say, to be on the safe, I would say your purchase price should not be less than $150,000.
Okay.
Based on 20% down. So what I'm seeing, I do have some correspondent lenders that'll make a concession based upon extenuating circumstances, where I can get a loan as low as $100,000, the loan amount. But they really like to see it between $135,000 to $150,000 minimum on the loan amount. And you could go up to a couple $1 million on the loan as well.
Oh, nice. A lot more flexibility.
Yes.
Is there anything else we should know about the investor cash flow loan?
I say there is no one size fits all. Just like an interest rate, there is no one size fits all. It's always going to be unique to the individual. So if you have any questions, any desire to learn more about it, you want to be put on a home buyer's journey or a home buyer's investor journey, contact me. I'm willing to give you a complimentary consultation on how we can make that work. And then I piggyback and give it back to Athena so she can do her rock star stuff and negotiate you the best deal possible and put you along that path and help you achieve your home ownership on the real estate side.
You know, consulting with a lender that knows what they're doing and understands these unique programs is so beneficial. So, Danny, it's
Yes.
great. So, to recap, and join me if I miss anything quickly, but to recap, 22% of properties sold in America are with investors. The rental value in the last 5 years have gone up to 24.9%. And the property values, an extraordinary 50.8. So, great statistics to talk about in this market. The cash flow loan program allows you as an investor to buy with cash based on your rent roll, based on your cash flow versus equity. And the qualifications are much more flexible. I love this program, and I hope that all of our investors in this audience and the investors that are going to be investors really understand and are able to join the 22%. So listen, bottom line, this is the bottom line. It's a good time for investors to jump into the market and do what they do best. And Danny, what they do best is building wealth. And we love to help them with that.
Yes, I agree.
Yes. So, Danny, thank you for joining the SoFlo Real Estate Show. I loved having you on here. I love the information you shared about the cash flow loan program. And for all of you out there, if you would like any information, if you would like Danny or I to consult with you, I will have an appointment link in the description so you can book your appointment directly. And you're more than welcome to reach out to us. I'll also have our contact information in the description on this video. So again, thank you everyone for joining Mortgage Monday. Danny, thank you for bringing this great information to the audience. And we'll see you all next week.
Thank you for having me. Have a great day.